Hi guys! In this video, I want to give you my 3 predictions for stocks that will outperform the market in 2025. Over the last couple of weeks, I have looked at many companies to find the best ones. And unlike many others, I also want to see how clear my crystal ball is and how well my predictions will turn out. So I will not upload this video and forget about it. Instead, I will come back with a follow-up video 1 year from now to see if I was correct or not. And because I wanted to challenge myself a bit and go outside of my comfort zone, I have also limited myself to companies that I don't have in my portfolio at the moment. So let's jump right in and start off the list with my tip number 1, which is Monolithic Power. Monolithic Power Systems is a leading semiconductor design company that specializes in high-performance power solutions. These power solutions are used for many applications from automotive over telecommunications to consumer electronics. Their products are optimized to be highly integrated and power efficient, which enables them to integrate multiple functions into a single chip. This helps their customers to simplify their designs by reducing the total count of components. In contrast to many of their competitors, Monolithic Power Systems is fabless without their own production, which keeps their operation very capital light. This, together with their relationship with Nvidia, has helped them to grow much quicker than the market. Over the last 10 years, they could easily outperform the S&P 500 with over 1000% total returns. Recently, their stock price crashed by more than 40%, which led to a 1-year performance of minus 1.3% though. But despite this dip, their 5-year performance is still quite a bit above their peers, as we can see in this graph. The main reason for this huge drop was a note from Edgewater Research to investors, where they suspect performance issues with Monolithic's voltage regulator modules that are used in Nvidia's Blackwell chips. This note left many investors quite concerned, which in the end has led to this huge sell-off over the course of just a couple of days. Monolithic Power, however, has already declined these concerns, stating that there are no issues with its products and that these will still be used in Nvidia's next generation products. And the experts from Morningstar are also skeptical about these reports and have kept their valuations for the time being. So, to me, it sounds like these rumors might be exaggerated. And even though I can't discount them completely, to me, it looks like the recent sell-off might be a bit excessive. The reason I think this is that the company's power management products have a wide acceptance on the market, which is shown in their diversified portfolio that is split over many different segments. And while their peers are struggling in the industrial and automotive markets, Monolithic Power can still show very nice double-digit growth here. In the automotive segment alone, they have projects worth of $1 billion in their pipeline. This is driven by the many automotive applications they are already covering and should still grow nicely over the next year when more and more of the electronic functions are dripping down from the high-end cars to the middle and lower class ones and are rolled out for the mass market. These trends have all helped them to quadruple their automotive revenue over the last 4 years. And if their currently still valid outlook for the computing sector that is driven by AIs and data center turns out to be true, they should also double their revenue in this segment in the next 4 years. So when we look at the overall growth numbers from the last 5 years, the company could grow quite quickly with 27% revenue increase per year, almost 45% growth in free cash flow, and a still very impressive 31% in EPS. And they could do all that while still keeping more cash on their hands than long-term debt in their balance sheet. So the company has essentially no leverage and a squishy clean balance sheet. But they still needed some money to fuel this growth, so instead of taking on debt, they issued new shares. This has led to an average annual share dilution of 1.8% over the last 5 years. This is quite high and quite a bit above from what I would usually like to see for my investments. But the company has already announced that this will not continue like that. Last year, they approved a share buyback program that will run until 2026. They also have started already with share repurchases, although not on a very high level yet. But it is still a turnaround from their previous strategy and can help them to keep their EPS growth going. The company is also paying a dividend with a smallish yield of 0.84%, but they could grow this dividend with a huge 26% per year over the last 5 years. And as an investor that is looking for companies with a high dividend growth, this makes them especially interesting for me. Their cash flow payout ratio is also still at a very reasonable 55%, and when we look at the dividend yield graph down here that shows the 5-year history of the dividend yield, we also see that even though the current yield is not too huge, it is still close to the highest levels of the last 2 years. So if you find the company interesting, now might be a good time to lock in this quite high dividend yield. What I don't like too much though is that Monolithic is paying quite high share-based compensation. These payments are almost on the same level as the dividend payments and have also grown at almost the same speed. So this is something that I would keep an eye on. Valuation-wise, despite the recent crash, the company is still not cheap. They are still well ahead of their peers in every one of these metrics. But this is honestly not very surprising with the growth numbers that they could show. When we compare the valuation to their own history though, the picture looks a bit different. Here we see that every one of these multiples, EV to EBITDA, PE and price to cash flow, are even close to the lower end of their 5-year range. And this valuation looks actually quite cheap when looking at the forecast. 12 analysts see an average 1-year price target that is 35% above the current price, with the highest estimation even forecasting a year-over-year return of 77%. The lowest price target is still on the current level. The growth should also slow down only very slightly, with an EPS growth forecast for the next years of 19.5% and a revenue growth of 70.4%. All in all, I think that Monolithic Power is a strong company with a very nice growth trend ahead of them, especially when looking at the long run. There is currently an increased risk that something is wrong with their chips for Nvidia, but up to now these are only rumors that have been denied by the company. And other analysts like Morningstar also think that these reports from Edgewater might be a bit overstated. I think that these potential issues don't warrant the huge crash, and even if they turn out to be true, by now they are already priced in. If it turns out to be false though, there is a huge short-term recovery potential with this stock. So I believe that the company can outperform the market over the next 12 months. And the longer I look at them, the more I believe that it might be a good move to switch out my portfolio position of Texas Instruments with Monolithic, especially at the current price. The second company on my list is also the only one I picked from the Magnificent Seven. And because I limited myself to companies that I don't have in my portfolio yet, I am not allowed to choose Microsoft or Nvidia, from which I actually believe are even better investments, especially over the long run. But I also find Alphabet very interesting at the moment. And in contrast to Monolithic Power, they didn't have a huge sell-off. On the contrary, over the last 3 months, the company's stock did appreciate by more than 20% already. But I still think that there is more to gain. Over the last 10 years, the mother company of Google could also significantly outperform the market, producing over 650% total returns to their investors. When compared to the other Magnificent Seven stocks, however, and peers like Tencent, their performance was fairly average, leaning rather to the lower range of these peers. One reason for this were the antitrust claims against Google from the Department of Justice. And while they have already agreed that Google did earn its current monopoly position rightfully by the consumers willingly choosing their products over their competition, the long-term exclusivity contracts that Alphabet entered with some mobile device producers to make Google the default search engine have crossed a legal line. At the moment, the case is still under discussion, and just a couple of days ago, Alphabet proposed some changes to the case. So the outcome is still unclear, but first of all, such proceedings usually take a very long time, and the Bank of America believes that the case will not be solved until 2026. In addition to that, it has been historically very difficult to enforce regulatory breakups of companies. And in the meanwhile, Google is still enjoying its monopoly position. According to impressionondigital.com, they are still by far the market leader with 90% market share under search engines, which leaves them with quite a moat that the current proceedings also won't change. And let's not forget that Google is also very active in AI developments, cloud services, and even autonomous vehicles with Waymo. And that's the segment that Apple just gave up, while Waymo is thriving. This strong position has led Alphabet to grow their revenue by 70% per year over the last 5 years, their free cash flow by 12.6%, and their earnings per share by even 26.5%. And they did all this while keeping a balance sheet that has been described as a force of nature. At the moment, they have more cash and cash equivalents on hand than debt on their balance sheet. And even if they wouldn't have this, they could pay almost all of their long-term debt with just the EBITDA of their last quarter. The results from the last quarter that was reported by end of October have also been nothing short of incredible. Their operating income increased by 34% year over year, with EPS increase of even 37%. This was driven by a strong growth in their cloud segment. What is also stated here is the traffic acquisition costs, or TAC, that was 13.7 billion in the last quarter. And this is a cost factor that might be reduced significantly when Google is not allowed to pay device manufacturers to be their default search engine anymore. So, over the short run, such a decision might even benefit their financials. And despite the huge run-up in the last month, the valuation of Google is still not too high. With forward multiples in PE of 24.7, EV to EBITDA of 15.6 and price to cash flow of 18.5, they are all above their sector medians, but so is their growth, as we just saw before. And when we compare the valuation to their own history, we are around the middle of the range here. While the valuation has recently increased again, it is still roughly on the same level as their 5-year averages. There are also 56 analysts that gave a 1-year price target for Alphabet. They see a maximum upside of over 20% and an average one of still 6.7%. So it might be a close call for Alphabet to outperform the market, but with an expected EPS growth of 19% and a forecasted revenue growth of almost 12% for the next 4 years. I think that these predictions might even be a bit understated. So overall, I think that Alphabet's strong position and investment in AI, cloud and even autonomous vehicles will pay off, and the company will keep on growing with above average rates. And while there definitely are risks with the currently ongoing legal proceedings and also the AI regulations that are currently worked on and introduced mostly in Europe, I think these risks are priced in already, and especially the effects from the discussion with the Department of Justice will not have such a huge effect in the end. I am still a bit torn on the long-term outlook for Google, which is the reason I am not invested, but I also think that they will have some great growth, at least in the next few years. Before we come to my last pick in a second, if you find this video interesting, please hit the like button and subscribe to the channel so you don't miss out on the next one. It would also be very interesting for me to see if you are already invested in any of the stocks today and what your outlook is for the next year. So please, let me know your thoughts down in the comments below. And last but not least, as my last tip for today, I believe that Uber will likely outperform the broader market in 2025. They are a global ride-sharing and technology company that was founded in 2009. So it is also by far the youngest company in my list today. Beyond ride-sharing, Uber also offers food delivery via Uber Eats and other freight solutions. So they are quickly becoming the go-to app if you need a car or anything delivered by car, with millions of rides per day and tons of data gathered about their users. Since Uber is only listed on the stock exchange since 2019, we can't look at the 10-year performance. Instead, let's look at the last 5 years that they just completed this year. And in these 5 years, the stock was pretty volatile, and right now, the performance is basically the same as the S&P 500. Due to this high volatility, the individual performance depends a lot on the entry point though. Over the last 12 months, the performance was not too great, with quite a sell-off in the last month. This sell-off has pushed the performance to basically zero right now, but again, we can see the large volatility of the stock, so this can change pretty quickly again. Compared to their peers, Uber had the second best performance in these 5 years, right after Avis' budget. The recent crash of around 30% since their highs is mostly due to two reasons. The first one is a deceleration in gross bookings. But even though the growth is slowing down a bit, the company is still growing quickly, and given its size now, it is only natural that the growth in bookings will slow down. I also think that it seems worse than it actually is, because last year's growth numbers of over 30% have partially been the result of new products and their growth. We also can't yet see a slowdown in revenue growth. In fact, the revenue growth has even picked up speed in the last quarters. And the numbers even look more impressive if you look at the constant currency growth. The second reason for the dip is, in my opinion, concerns when it comes to autonomous vehicles. And while it's true that there is some risks from producers of such robotaxis like Waymo or maybe even Tesla in the future, I think that the risk is overestimated, and the value that Uber can bring to this market is underappreciated in the short run. Uber already has 14 partners in the AV space by now, and they are offering APIs to support fleet management for third parties that can bring a huge benefit to such AV providers. This September, they also announced a partnership with Waymo, for example, to bring autonomous ride-hailing to Austin and Atlanta. And let's not forget that Uber isn't limited to ride-hailing. They also operate as a delivery platform, especially with their food delivery Uber Eats, and manage commercial freight services, although this currently represents a smaller portion of their revenue. With all these services, they are providing millions of rides a day, with which they are gathering a ton of very valuable data. From mapping the roads, over tracking where people go and what they like to eat, they are more than just a ride-hailing or delivery company. This kind of data has the potential to be extremely valuable to their own businesses, but also their partners. This value is just starting to be leveraged with the advertising they are doing in their app. But I believe that there is much more value to be had with this data. We already saw the growth of the operating metrics and also the revenue growth from the last quarters. Over the last 5 years, this has led to a revenue growth of over 26% per year. But unfortunately, I can't give you any growth numbers for free cash flow and EPS. Because their free cash flow just turned positive in 2022 and their EPS in 2023. So we need to see how this develops over the next few years, but the outlook of analysts is quite bullish, as we'll see in a bit. To fuel this growth, the company has taken on quite a bit of debt and also issued a lot of new shares, which brought the dilution to 4.17% per year over the last 5 years. That left their balance sheet also quite leveraged, with 7.5 times long-term debt to EBITDA. This is quite a bit higher than what I would like to see for my investments, but it doesn't mean that the company can't grow any further. And same as monolithic power, Uber has also started to buy back shares recently. In the last quarter, they have repurchased $375 million in common stocks, with a plan to further increase this in the coming quarters. The valuation of Uber, while not cheap, is also not in hype territory yet. With a PE ratio of 32, an EV to EBITDA multiple of 20.3 and a price to cash flow ratio of 19.7, they are above the respective sector medians though. Unfortunately, it is a bit meaningless to compare this to their own history, because as they just became profitable, the picture is good. In the 3-year history, we have a huge range for all of these metrics, so it is hard to read any meaningful information from this. And even when we zoom in and only look at the last year, the range is still pretty huge, but we can at least see that the valuation came down steadily over the last 12 months. But at least the 50 analysts that gave a price target for Uber are very bullish. They see an average one-year price target of 90.90, which is around 48% above the current price. The most optimistic of them even expect an upside of almost 100% in just 1 year, while the most pessimistic of them still see an upside of more than 20%. So they are all fairly optimistic for the company. The EPS is also expected to grow with a CAGR of 46% for the next 4 years, while the revenue is forecast to grow with a yearly rate of 15% until 2027. So these analysts see a huge growth potential from here on out, and the expectation of the company itself also points to a pretty spectacular growth. Uber itself thinks that they will grow their bookings in the mid to high teens rate, their EBITDA in the high 30-ish% per year, and their free cash flow by more than 90% over the next 3 years. And if this turns out to be true, the current valuation would be more than justified. I already discussed some of the risks earlier, so it is of course not certain that it will happen like this. But I think that the risks, especially over the next couple of years, are well under control, and that the current price and valuation are pretty fair for a company with these growth expectations. Over the long run, I think that their business might get under pressure from AV manufacturers or other ride-hailing companies, but at the moment, Uber has by far the strongest market position. That's why I believe that at least over the next year, Uber will outperform the general market. And as I mentioned in the beginning, I will come back to these 3 predictions by the end of the year to see how well they turned out and if I was correct or not. So, what is your prediction for these 3 companies? Do you also think that they will outperform the market? Or do you think that I'm completely wrong? Please let me know your thoughts down in the comments. And if you're looking for a dividend growth company that shows every sign of a great compounder and that could grow its dividend by over 25% per year recently, this video might be interesting for you. That being said, thank you so much for watching, guys, and see you in the next video.